when no one else was.
Yeah.
And as soon as we looked into it, 1 or 2 years later, that did what every other state was doing prior to that. And you can just look historically. And then going to what Matt just mentioned now, like everyone else looking elsewhere, but I think Melbourne and even regional areas like such as Geelong here is doing well, has been very stagnant.
Yeah.
So I think now's the best opportunity for this.
Yeah,
for our area.
I think it's what Warren Buffett saying, it's be wary when others are greedy and be greedy when others are wary. And an old boss of mine who was a funny Polish man, who still is a funny Polish man, but he's not my boss anymore. But he used to say when a market's really hot, it's when you burn your ass. So we try and get in before the market's hot, and it's proven to work really well.
Yeah, so with the property price, even though they haven't gone up a lot since COVID, they're sort of stagnated, and obviously construction costs have come up somewhat. Where do you find the best opportunities in the market? And again, traditionally it was more the house and land stuff, and I think people have to look away from that. So what we're doing here is built to grow. A lot of our clients are investors and trying to look not only long-term capital growth, but getting that cash flow. So like student accommodation, NDIS, co-living, that's what we're doing. And I think Matt can sort of...
Yeah, we always look for areas like I do have a specific strategy. I'm looking for areas that are positioned in a certain way from a supply and demand standpoint. So it's called the urban sprawl, not to get too technical, but trying to go into areas that we know are going to fill up as far as the amount of land that's available within a certain period of time, maybe 5 years, 10 years. Because once that area fills, we know that it's going to diminish in supply, so it has to almost go up from a value standpoint. And that's on top of the market just performing how it will perform anyway. So if we can get properties, in the new build space that generate a strong cash flow, ideally we're buying them at or below the median house price in that area as well. We're pretty confident that it's going to do well for people. Yeah. So maybe not overnight, but longer, you can do pretty well.
So I had a client actually call me on the weekend, or a potential client. They've had a bit of savings. They weren't sure what the market's doing, which, a bit of uncertainty. Now they're a bit more confident because a couple interest rate drops. Their budget's around 800,000 to 900,000. So if you had someone come to you guys with that sort of money, I think it was about 20% deposit. What would you recommend they do? Where would they look at investing or building?
It's case by case. Everyone's different. Everyone has different targets, different things that they want to achieve. We have a system that we've developed called the guidance system. You didn't actually use that software because it wasn't...
I bypassed that?
Yeah, you did. You didn't need it. But it plans out everything that someone wants to achieve over a long period of time. So, ideally, if it was a balanced approach, I'd be looking for something like what I just said. Something that's got good resale value. Not that we want to sell it. But we expect to be able to get some good uplift in value and create some equity that's going to look after itself from a cash flow standpoint.
So what if it's their first investment? So they've got their own home that they've obviously paid off or close to paying off and got a bit of equity. What would you recommend as a first off investment?
Yeah, we specialise in new homes. So, I like, as I said, Melbourne at the moment. I like Geelong. Geelong's limited as far as how much supply there is here as well. Like, obviously, it's going to take a while to fill up, but there's a lot of people moving here. So if we can get something that's going to strengthen their borrowing capacity, because what most people do is make the mistake of buying something that limits their borrowing capacity. So as long as the numbers stack up, that's what I put them into, because we can then expand further a lot faster than if I do it the other way around. I hope that helps. Does that?
That's good. That's good. This keep going.
Yeah, just a second. I'm just gonna break into the pieces. There you go. Done.
Another question that I get, I don't probably get asked, but you might get, what are common traps or mistakes that investors do? So obviously, family barbecues, everyone's an expert, and they go off buying something that they're telling everyone how good it is. But so obviously investing's good, but it's when you obviously buy the right investment. So how can you help people navigate or make a decision when...
Easily the biggest mistake people make, I see it all the time, is that they don't understand the numbers, the accounting side of it. Especially for the clients we help, mum and dad investors. They're not wealthy yet. Some of them are, but most of them aren't. And you get wealthy by understanding the structure of how to set it up. reducing tax, reducing the amount of interest you pay to the bank, all of these expenses that take money out of your pocket as opposed to putting money into your pocket is where we help them. It's the same thing we see with every person most of the time. So the property will do its thing as long as we can get that cash flow looked after. But if the accounting works and the numbers works, away you go.
Yeah.
But most people don't understand it.
When's just to fly from it, when's the best time to buy property?
Yesterday.
I knew you were going to
It's
say that.
always yesterday. It's always yesterday. Like it's the same thing. I get that too. We're just going to hold off for now because my grandfather at the barbecue said it's not a good time.
Interest rates, the timing.
You're just chasing your tail. Like as I said, we can't predict exactly when a region's going to boom, but if we know that a lot of people are moving to it, and there's not enough houses for the amount of people that are coming here, so the law is that it has to go up in value.
Yeah. So as a 20-year-old, well, maybe ask as a
You've
20.
aged poorly for
No, mate. If you're a 20-year-old, where would you look at saying you just got your out of home, maybe renting, you got a good job, maybe second, third year into your job, you're actually progressing up through the ranks, so you got a bit of extra income. You might be hitting up that next tax bracket as well, like we said. So what would you recommend? Will they maybe buy their own home or maybe buy investment first?
Yeah, I mean, buying a first home can be very valuable from obviously a government assistance standpoint, getting your first homeowner grants if you qualify for those, stamp duty exemptions, those kind of things. Take advantage of that. Obviously, you can avoid capital gains tax with being a first home buyer as well. However, acquiring investments as quickly as possible is very important because I don't actually see the family home as being an asset. I think it's a liability. So the quicker that we can get, you mentioned tax brackets, like high depreciation, so we specialise in new homes, getting your tax brackets down, generating income and expanding, that's where the goal is. So
same thing. I definitely agree with Matt. Being a builder, I've obviously been building for 23 odd years for other companies first and for myself. We actually had, when we first got married, we had a house and land package.
We got married.
No, me and my wife got married, obviously. And then the house we stayed in was like 10 years plus. And then I'm building all these high-end luxury homes for clients. And my wife's like, well, how come we don't build one? And it's exactly the same reason. I'd rather stay where you're comfortable, stay where you can actually afford not just the mortgage, but also living cost. Obviously, planning to have kids and whatnot. And then any extra money we had, we actually tipped it into the investment property. And looking back now, it was a bit of method in the madness, and that's sort of set us up a long term because we had other friends or family do the opposite. So they'll go in and buy the best house they could possibly build or get in the best area. And looking back, it sort of capped them on what they can do, and they're sort of still stuck there now, unfortunately. So we did the other way. We sort of got first homeowners grant, regional Victoria. I think back then was 36,000, which is a lot of money. I think the house and land was about 330 odd thousand.
10% equity straight away.
And it was so instant equity, and then we stayed there for 10 years. 10 years it doubled. Obviously, once we sold, didn't have to pay any tax because of his own personal principal place of residence. So
I mean, long story short, don't overthink it as well. We also have another business called Purchase Homes, which is specifically helping first home buyers. Don't wait because you don't have a 20% deposit, or don't wait a year because you want the dream home first. Get yourself into the market. The wealthy generate or acquire assets, income producing assets, and they build upon that. And then they lend against the assets to generate more income and buy more income producing assets. And that's when shit becomes easier. And that's why the rich get richer and the poor get poorer, because the rich are acquiring assets.
And it's inflation. People are saying, property can't double every 10 years. Or if you look at, what a cup of coffee costs or a slice of bread, everything just goes up. So if you're trying to save or work hard to make your money and save, the longer you do that, you're not going to beat the property market. Or, if the house is worth, say, 600,000-700,000 today, if you try to save a deposit for that home, in 3-4 years' time, naturally, that house will go up and then your deposit still won't catch that.
The value of money generally halves every circa 23 years as a guide. So if you keep $100,000 in the bank for 20 years, it's actually worth a lot less down the track than what it is now. But if you have a $100,000 asset, a house or something along those lines, in 20 years, it's worth $200,000, $300,000, $400,000. that's where the difference is made.
There you go. Said it the way I was supposed to say.
That's
Thanks,
right.
Matt.
All good.
And we'll check some more questions.
I can't build a house like you can
yeah.
build a house,
Yes.
so
Exactly. Inside Buyfair. So if we had a client that wanted to come to you, what's the actual process?
yeah,
So that's it.
it's pretty detailed actually. We have a pretty thorough.
Our process, we just had a cup of coffee, signed something, had to pay a few grand.
We spoke for a good 2 or 3 months before
We probably did,
was
yeah.
acquired.
Takes a bit for me to commit.
Yeah, we have a pretty thorough process and it's evolved. Essentially we would meet with someone first and understand whether we're a good fit for each other.
Yeah.
You know, we don't just work with everyone, and we're obviously not someone that everyone wants to work with, depending on what they want to do. But yeah, it's important to dig deeper and understand if we're a fit for each other first. We then introduce them to our team. I like to say that when you work with us, you get an army of advisors that come and work alongside you as well. You know, financial planners, accountants, finance teams, the whole works. There's a fair bit to it.
Builders.
Yeah, builders, yeah, exactly. And we have obviously a tool that I mentioned before called the guided system. It's a very detailed planning process as well, which allows you to essentially plan out a blueprint of what you want to achieve over a long period of time. And then we get to work on setting up your finance and working towards achieving that.
Perfect.
Yeah, there's a bit more involved, but that's the high level.
Yeah.
High level.
Oh yeah, this is a good one. Can you, sorry?
Yeah, no pressure.
Can you share us maybe 1 or 2 success stories with a client or previous client or current client?
Yeah, we can. I've been in the industry since 2007 for starters, so I think it's not just our business's outcomes, but working with people for a long period of time has been heaps of amazing outcomes, and it's very rarely gone badly, if that makes sense. Your outcome's obviously a really good one. I do like that story, obviously being able to tenant the property out so quickly at such a strong return. I think it's $2,200 a week in rent you're achieving for about 820 grand outlay, something like that.
I think so. When we met, what year did we buy that one?
2023.
Yeah, that was a fair buy, that one. 2023, a couple of years ago, I already had one house getting built in Perth. It was a co-living, so a 2-bedroom and 3-bedroom on the one title. So they were renting out as 2 separate dwellings, essentially, which that was a fantastic purchase, that one, which I did personally on my own. I was looking at a second one, but I wanted something different in a different location. That's where we come across Matt, which was around 835,000, but instead of being north of Perth in Two Rocks, which is about 45 minutes north of Perth CBD, this one we found in Beachborough was between the Perth Airport and Perth CBD. I think it was about 11 k's. More infill. This was a different strategy. Obviously, I've got a few properties already, so I needed something that produced high income cash flow. So this was 6 bedrooms, 6 bathroom property with a shared facility of a kitchen, laundry and garage amenities. So go on for numbers, which we can show anyway. We could do that in the background, numbers and photos. So purchase was 830,000, house and land, full turnkey, included the furniture pack. Rental return was 115,000 per annum. I think the property management fee is 7%. So it was actually a fantastic end result.
Yeah, and it makes us feel good when that happens, obviously, as well. And that's why we try and take out, the packages that are tight. Like if we can get a strong income for you, then you're not worried if there's a little bit of vacancy in one room for a few weeks. It's fine because it's going to cover its expenses. Another one, there's so many different outcomes. We had one a little while ago which was interesting. The property was built in Queensland. It's a townhouse for an SMSF purchase, and the valuation came up short. So it was about 25 grand short. This house was finished about 1.5 years ago now, but I remember the investor being quite upset with us, not that we can control that, and they were quite stressed. And I said, guys, you're thinking too short term, it'll be fine. We sold that property for that client a couple of months ago for about, I think it was about $140,000 profit in 15 months or 18 months or something along those lines. And I just give that example because I mean, a year and a half's not a long time,
Yeah.
but the longer you think, the better you're going to do. So
Yeah.
yeah. But most properties upon completion are doing really well, and if we can get that income to where we want it to be, we can then go again, and that's when you really start snowballing the outcome.
Yeah, well, that was my strategy going back to the beach bar. It was not buying something and hope the valuation went up to a certain figure.
Yeah.
So to be honest, I actually haven't had that one revalued. Like that was finished 7-8 months ago. My actual plan for that property was not building something, valuing it at the end, trying to make another 30, 40, 50k. It was actually just getting a positive cash flow. That's going to enable me to borrow again and do another property.
So the secret to that as well, and this is talking about structures before and the mistakes people make, is like, so now that we can value that properly, and that's the key, is to valuing it properly. So we'll do a commercial valuation, which is going to cost you $2,500, $3 grand. But they will value it based on the yield or the income that's been generated on that asset. If it doesn't come up at, I'm educated guess here, 1.1, 1.2, I'd be very surprised. And that's just put you in a position to use that to go again and so on and so forth. So
no, perfect.
Yeah,
sounds good to me.
You're welcome. Thank you. You paid for it. You paid for it. So you did the hard thing.
What's this quick fire social friendly content? Oh yeah, it's just some quick questions. Biggest myth about property investing? One suburb you invest in today? Best deal you've ever had? Worst buy? You're off for these ones?
Yeah.
Yeah. All right.
Yeah, you can ask me.
Oh, perfect. Make sure we're rolling. What's your biggest myth about property investing in Australia?
I think that home ownership's the great Australian dream. I don't think that's the Australian dream. I think investment ownership should be the great Australian dream.
Yeah.
You know, we need banks to buy homes. However, it's the banks selling you their product so that they can make money. You make a lot more money when you set it up properly and you invest over having the dream home.
Agreed. I reckon you should pay for your dream home without a bank.
Yeah, when you've got, excuse my language, but when you've got the fuck you money, it's different.
Yeah.
Like, if you've got fuck you money, go for it. Like, go and buy your $10 million house if you can, but
because you're gonna if you take out the big mortgage, you're gonna bottleneck yourself for future investments or just day-to-day living and added stress on yourself and your family for no reason.
Debt will never send you broke. It's the cash flow that will. So people saying, "Oh, I don't want to take on more debt at the moment." It's like that's also how the wealthy get rich. They use debt, other people's money to build assets. If you can't manage the cash flow because you don't have enough income, then that's where the problem comes in.
Checkmate.
And things like car loans. We do a lot of work with Buyfair workers, and I love them. They're great. They're good fun. However, they like jet skis and fancy cars and shit that takes money out of their pocket.
Yeah, it doesn't matter how much you earn, that's what you spend.
The more you earn, the more you get taxed. So that's what most people don't understand. Well, they do understand, but they don't. So they think, oh, great, I'm making a shitload of money, but you're actually just paying more.
Yeah, or they don't do anything about it. There's so many things you can do to reduce your tax, and one of the avenues, obviously, we're spruiking, obviously, because we're in the field, but property, like the tax rules have been written for that reason, so you can do that. Like
I've just started reading Kerry Packer's old accountant's tax book. It's unbelievable. It's brilliant. But there's that famous footage of Kerry Packer in the Senate hearing saying that you guys don't spend the money that I give you very well, so you need to get your head checked if you want to pay more tax. So,
amazing. I love that thing.
What a boss he was.
I saw a book yesterday. I actually bought Steve, that Dora, the CEO. I bought him yesterday. And that one was next to it.
$30. Yeah, $30 you get to learn from Kerry Packer's accountant. It's not hard.
So if I was to pick one suburb to invest in today, what would that suburb be?
So this is a hard question because there's so many, like as I said, it's that as long as it's within that region of what I was saying before, like we can see an area that we feel is undervalued to a degree and close to that urban, like it.
You have to take off.
One suburb is very hard to nail, but I mean I can give you examples. I really like. A few years ago I was saying Point Cook. I was saying Cranbourne. You know, this is 5 years ago because you could see. Just get on Google Maps. You can see that it's nearly full. I'm like, go there, go there, go there. That's what we said to the clients. The clients are now going, thank you, because it almost has to happen. So now it's like, Deanside, Officer, Clyde North I really like, Geelong to a degree, like
Yeah.
Warm Ponds is nearly, is filling up.
Yeah, yeah.
You know, these are the areas, like, you've got the Surf Coast 15 minutes away,
Yeah, Melbourne's still just off the new ring road.
like
That's
Lara,
right,
like there's a lot of land there still, but it's positioned strategically. So you want to look at areas that are driving people to that area. Like, why do they want to be there, and are there going to be more people wanting to be there in the future?
There's a lot happening in Avalon as well. So
Yeah.
Lara's just, stone's throw away, airport and whatnot.
Yeah.
Okay. So what's your recommendations for a first-time investor? What steps should they take before even considering buying a property or looking at property investing?
Speak to us.
There we go. He's waiting to answer that one.
No, get your affairs in order. Like, you got to understand the landscape before you go and make a decision. So financing is very important. For example, understanding your bank statements and what might be a red flag to a bank. If you already present to a bank and there's red flags everywhere, it's a lot harder to rectify later.
Yeah.
So it's like a court case. That's how I see it for applying for finance from a bank. You've got to put your best case forward. So let's put
And having the best team behind you too, or around
Exactly.
you, and advisors, yeah.
Let's have your accounting in place. Let's have your spending in place. Let's have your savings in place. Like, you've got to put your best foot forward from the start, because it's a lot easier to build that foundation then. So,
Credit cards, big no-no.
I'm gonna. Well, there's another myth.
Okay.
From an investing standpoint, credit cards can be amazing,
Yeah.
incredible. When you're using them for the right reason, we can teach you how to structure that.
Frequent flyer points? No.
Yeah, well, absolutely. Like, as long as you're not paying the interest on the
Yeah.
credit card, like, you can use, there's ways that you can use that very effectively.
Yeah.
But yeah, excessive credit cards where you're using them for the wrong things,
Yeah.
like you're going to Ibiza, like, cool, it's fun.
Yeah.
If you actually want to get ahead, you're going to have to
Sounds good.
sacrifice at some point. Like,
Yeah, go on to credit cards. Yeah, as a business, like we
Yeah.
put obviously most of our accounts are monthly, and we got some big ticket
Couple of
items. Well, you got your trusses, your windows, so we actually pay that on credit. But we haven't gone over by one day ever.
Yeah.
So use those points, obviously. So every year that we go on a family holiday, they use from credit card points.
Just quickly, so when you have an offset account on a family home, so like if you have 100,000 in savings in an offset account, it's offsetting $100,000 worth of interest that you're paying to the bank. If you pay for everything, all of your living expenses with your credit card, it means that you're keeping savings in that offset account longer. Your interest is calculated daily on a mortgage.
Yeah.
So by doing that, as I said, as long as you're not paying the interest on the credit card, you're actually taking a huge amount of how much interest you take off paying to the bank, and also term. So if you pay off your mortgage 10 years quicker because of one structural change, what does that mean to you? You might be paying $4,000 a month. So that's 10 years of $4,000 a month in mortgage repayments you don't have to pay.
Yeah.
So it's knowing how to do it. It's not complicated. You just got to know how to do it.
Yeah.
So.
Very good. Is that guy still on his lunch break?
He's just sitting back there. Oh, this is good. He's getting a free lesson.
If someone gave you $1 million, what would you do with it?
Meal.
Retire? $1 million.
Oh, yeah. That's a great question.
Is it? Yeah.
That's a really good question.
Thanks, Sam.
No, that is actually, I've seen that question on our
It's
chat.
like social media.
Brilliant.
Yeah.
People love to see.
It's a really good question.
Yeah.
Yeah, I can answer that for sure.
Good.
You're on the
Uh,
Have you recorded anything? Yeah.
No, I'm just gonna.
Imagine.
I've done that. I've done that before. The first podcast I ever did,
Oh, no way.
we filmed 2 episodes
Yeah.
and it didn't film any of it. I was like, fuck.
Wow.
It's pretty funny.
Is that going in?
Yeah.
Yeah. So, Matt, if you had $1 million, what would you do with it?
I love this question. Property related, I would imagine.
I hope so, yeah. That's what, yeah.
Yeah, so obviously leverage is the thing that I would try and do. So I would try and get into as many properties that cash flow positive as I can. So for example, $200,000 deposit on 5 properties, or even a $500,000 deposit on 2 properties that are cash flow positive.
Yeah.
Because I know that once they're complete and the income's coming in, I'm going to have the equity and I'm going to have the cash flow, and then I can just waterfall on.
Amazing.
And I do that until I don't want to do it anymore.
Just keep on keeping on. Yeah.
The last thing I would ever do is go and buy a house for $1 million and live in it. Like, I just wouldn't do it, because you actually want borrowings, because it's an offset. If I'm still earning income, which for $1 million you can't retire on, so it's not going to set you up for life, but it can help get you started pretty well.
Great answer.
Thanks.
Is there any other ones, Sam? I've sort of just cut through some of these.
Yeah, they're really good questions.
Yeah.
I feel like it's been...
Worst property mistake you've seen someone make? That's a good one.
Yeah.
Oh.
Just need to think about that quickly. Yeah.
Ready to go?
Yeah, got it. Rolling.
Roll. What's the worst property mistake you've seen someone made? Whether maybe it's a client that's come to you and second guessed, or I know better, or maybe over a barbecue chat that someone told you this would be fantastic, and then roll on, 12 to 18 months later, it's probably not the way they thought it would roll.
Yeah, it's easily, and I say it all the time, it's hindsight. We wish we just did that when you said to do it. We wish that we bought that 2 years ago. We wish that it's always regretting what they didn't do as opposed to what they did do. So the mistake is not, as I said before, it's almost never been the case where someone's gone, I wish I didn't buy that. Yeah. It's always, I wish I did buy that. It's always the biggest mistake.
Yeah. Same as the previous question, when's the best time to start? Yesterday, even for myself, sometimes you buy something, it probably hasn't gone as good as what you thought, or maybe another property that you could have bought instead. But the longer you hold it, the time does its legwork, and it's,
Don't wait to buy real estate, buy real estate and wait.
There you go.
Yeah.
Hook of the day, Jesse.
Good questions.
I read it, but I forgot what I was saying. Oh, yeah. When assessing a property deal, what actually is the key things that stand out, or things you guys have to research to make it a standout hit, to give you confidence and give your client confidence in order to make a decision to run with that, for example, package, or this area, or that type of actual property investment? Because there's so many different areas, properties,
There's a lot that goes into it. I think obviously it's case by case depending on the person. So obviously acquiring something that's going to fit to within their means and support them to be able to grow further, like we were speaking about before.
Yeah, so if it's their first property, their third, their fifth, or their last investment before they retire. Yeah. Also budget.
And it's understanding a portfolio too. Sometimes we'll change the strategy to diversify a little bit.
Yeah.
If it's their first investment, we want to put them into an area that has good amounts of amenity, things like transport, things like shopping centres, schools, medical centres, sporting fields, pubs, those kind of things. Areas that are attracting tenants and people that want to buy property. Obviously, like I said before, areas that don't have too much supply close to them. We're not just going and putting something regional, because it's going to take longer to get that return. And then obviously something that we have a lot of confidence will generate the outcome that we're saying will generate from a cash flow standpoint. If we know that the numbers are protected from an income standpoint, we know what their mortgage outlay is going to be, the holding costs, etc. It doesn't need to perform amazing in the first 2 years, 3 years, like ideally it does, but if it doesn't, they're still holding that asset. If they lose a job or they can't, earn income like they normally would, then you don't need to fire sale that as well. That's really important. So, there's a fair bit that goes into it though.
I can imagine. Obviously, over the past few years, there's been a lot of property developers. Like, this is especially what I see in my field and with my peers and other builders and developers, that there's a lot of people doing, knockdown rebuilds, like townhouse unit sites. Obviously, with the price of land going up so much, with the price of builds going up, a lot of those things actually don't stack up now. So where do you see the opportunities? Because what we've sort of found a little niche that we're trying to accelerate and we're finding a really good appetite for. But what do you think will work? I think there's the granny flat that's sort of come about, there's co-living NDIS. But what's the niches that you think you can help your clients with that can have both instant uplift but also the cash flow?
I think adding value from a cash flow standpoint, like you don't you don't have to be a genius to add value to something. Like, you know, you spend $700,000 or $800,000 on an asset, you can generate an extra $500 a week rent, which we can do these days if you know how to do it, is valuable. You know, things like tiny homes that you just mentioned. We've just sourced a national exclusive rights to a new tiny home product, which is incredible. We haven't even released it yet, but being able to, you know, potentially invest your super, for example, to put a tiny home onto a property that generates another $400 or $500 a week in rent is smart.
Yeah.
And that's the kind of things that we do. We don't just go, okay, cool, here's one of the problems. I will say this. So about 80% of homes that are being built are traditional 4-bed, 2-bath, 2 living area family homes. However, the house demographics are changing.
Yeah.
So family sizes, house sizes are getting smaller. So we've got more people living by themselves. The problem with that combination is that there's too many houses of the wrong
type,
but there's not enough houses overall for everyone. So this house here, 6-bed, 7-bed, 7 baths, you know, with specific features that allow people to live comfortably in their own living space, it's a no-brainer. Like, this will rent for what, $1,500 to $2,000 a week, something like that.
Yeah, and it's obviously initially thinking about this type of home and design was more targeted to young people starting their working life or at a university or in university. But having said that, the one we built and we finished a couple of months ago, there's actually not one university student living in there. So like you said, there's a lot of people that need homes, but the type of homes out there and the cost to actually have an old or new established home where they're paying $600, $700, $800 a week, people not only don't want that but can't afford it. So there's actually other opportunities like the flats or co-living that I think that needs to be done. That no one's actually doing.
It helps the tenants too, like you're providing more affordable products in areas that they want to be, which helps them save for their first home, or you know, helps them build a bit more of a future for themselves as well. You know, unfortunately, the government talk a big game when it comes to we're going to build 1 million houses in 5 years, and it just never happens. So it's the private market, it's people like you and like us that are coming up with different ways to provide more housing for people. It helps the investor, it helps the tenants, it helps everyone. It helps the government too, because it takes, you know, a bit of pressure off them. Yeah. So we've got to evolve the way we think. That's why when you work with us as well, it's not just, oh, hey, let's just go put this here. It's like, no, let's think about this. How do we get the best outcome for everyone?
Yeah, you can easily, like you said, you can pick a particular suburb or area, put it in a 4-bedroom, 2-bathroom, double garage, and that will still do well, and it'll still serve the purpose of investing, and it still will grow over time. But is that the best? That's just, I think it's a lazy answer, a lazy solution. And same as us, built to grow, we're always looking at those little niche, little challenges, doing things that other people don't do, and that's what gives our clients more value, I think. So
there's a couple of guys on social media that have done very well. They've got really good buying advocacy property groups, and I really like them, but they challenge and they put down people that sell new homes to investors and these people getting started. The reality is that not every investor can afford to buy in blue chip 2-rack locations. It's just not possible. They're getting started, so they've got to start somewhere. The second thing is that the government incentivise you to build because they want more homes built. So we can take advantage of different incentives from the government to do that. And the third thing is that we can't get a good income or rental return on a blue chip property that's going to cost you $2 million and rent for $1,200 a week. It's too much to hold. So if we can put you into something for $750 that rents for $1,200 a week, which we can do, by the way, that's a pretty good outcome.
It's a great solution,
That's how I see it,
So we've maybe take a step back. So Buyfair property, how long have you actually been around for?
I actually launched Purchase Homes about 5 years ago. So we still have Purchase Homes, but Buyfair's, I think we're about 3 years in now, so it's pretty fresh. The reason why we launched Buyfair, I've been in the industry for about 15, 16 years now, and always sort of worked for the bigger providers in the space. I wanted to be able to deliver something at a much higher level where people felt part of something. So we're young, but we're good.
And where do you see yourself in the next 3 to 5 years, or even maybe 10 years? Is that?
Yeah, I think continuing to evolve the product. I want to have the best end-to-end service in the industry. As I said, we're not pretending or planning to be the biggest provider in the space. We don't want to be a massive investment company that sells 100 houses a month. It's too much.
Yeah.
We want to be able to maintain that standard of going above and beyond for people, and that's what gets me up in the morning as well. So
yeah, we're very much the same. So the first 3 years, if I take a step back, we've been around to 10 plus now. But the first 3 years was finding your ground, finding who, not only your clientele, but also the people around you, the best setup and that you feel most comfortable with.
Yeah.
And I think for us, 3 to 5 years was sort of we're built on the back of that. And then 5 years plus, because we had the right type of, you know, trade suppliers, staff, and we felt like we were in control of it. Really just took off.
How long's Build to Grow been around for?
Nearly 12 years now. So yeah, which is been fortunate enough. We've gone through a lot and look back now, like how building was and what we were doing 12 years ago to today is so different. Even though we're doing the same thing and same, you know, system. Building a house is easy. Everything else around it is the thing that's challenging. So yeah.
Yeah, and you guys are amazing at what you do. I can see that in your product. It's you put care into it as well. I mean, I've worked with every builder under the sun, you know, and nothing against the big volume builders, but I used to work for them. You know, the reality is there's big overheads. There's a lot of people to feed. There's a lot of expenses, and it's dollars and cents.
Yeah.
It's just the corporate environment. The small business is where my heart's at, and I love it. I'm always learning and trying to get better, and you know, clients' outcomes and feedbacks on what we deliver to them is my main currency.
Yeah.
So
Yeah, we're quite the same because prior to first kicking off, I was part of a franchise, and the one thing that I couldn't get around my head was they just want to drive up more and more builds.
Yeah.
And I've always been a builder. I've always been capped at a certain amount of builds, not only because all the main things are quality, but also the people we engage with. Because as you get bigger and bigger, you can only control so much, that I felt, and that's why we've, you know, after that 5 or 7 year period, we've actually capped it at that specific job number or turnover for that reason. Because even though, you know, you can make more money, I'm a bit of a stickler, and I actually like to be on site. I like to be involved in every, you know, with every client, with every process, and to be honest, that's actually what's made us to be who we are today, by just doing that. And every client to me, at the start they're a client, at the end they're a friend.
Yeah.
And I feel like really like I'm part of their, if it's for investment as an investor, or if it's their own family home, like yeah.
I'm the same. I've got a lot of friends that are clients, and the other way around, even clients have become friends, and friends that have become clients.
Yeah.
Like, it's always a bit scary when they're your friend first and they become a client, because
don't know which way it's going to go, but
but look, I think at the end of the day, like with a smaller business, with someone that cares about what happens, like, you know, if something does happen to go wrong, like, we're not going to stick our head in the sand.
Yeah.
We're going to be there with you, supporting you along the way, doing whatever we can, you know, to help. Because I mean, investing does go wrong sometimes. Let's be real. It's not always sunshines and rainbows, but you know, usually long term, if you do it properly, you're going to do really well.
Anything else on this? No. Do you have any questions then?
Yeah, well, can I ask you?
Yeah,
I mean,
100%.
is that all right?
Yeah.
Is that?
Let's keep it going.